Okay, it's the last time I can say a summer Friday. Today's the last Friday of August, last Friday before Labor Day weekend, and we got a few signs of weakness today. So I'm going to break down what those signs of weakness mean in terms of how they impact our posture, our outlook currently, and heading into the end of the year. So I'm going to talk about the seasonal factors, the technical factors that give us some expectations into December as well as even into next quarter. And today's trade idea looks at a sector that had shown some strength, but we do expect to head back down towards the bottom of the list, so to speak. So let's go ahead and get started. Today is Friday, August the 31st, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight. Welcome to those of you who are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel. Mouse over the Market Scholars logo right here in the bottom right corner of a video. Then click that red subscribe button that pops out. Also, click the thumbs up icon that's right down below the video. That lets me know two things. David, I liked the video tonight, and do it again Tuesday. Keep on doing these videos. That's a really easy way for us to get your feedback. You can do that right now while you're watching. Also, comment on anything that stands out to you. Love to hear your thoughts and what you're seeing down below. You have to scroll down further below. Subscribe to our daily Market Outlook email. There's a link popping out in the top right corner of your screen. Click that link to subscribe. Also, follow me on Twitter for more content like this throughout the day and throughout the week. And also remember to join our Market Outlook community on Facebook. All right, well, let's start off looking at the market forecast indicator here on the S&P 500, as we always do. You see, with the pullback today, even though we actually finished with 1/100th of a percentage point gain, the pullback here, I mean, not even a half a point gain. So that's how small that was. But it was pretty much a down day. You could consider it a down day. It was down for most of the day. It brought the near-term line actually a smidgen below 20. When I was doing my technical analysis class this morning for our premium Market Scholar subscribers, we were looking at this near-term line. We had kind of a line in the sand drawn below these lows that we were watching for to see if we were going to hold it from the middle of the day on, or if we were going to break down and be more bearish. We held, and so the near-term line finished between the 20th and 50th percentiles, like we did last week. So this would have been last Thursday. So last Wednesday and Thursday was like this little pullback that brought us down here. Well, today, because we came off the lows, it brought the momentum line up. See, the momentum line was also down again for a second day in the reversal zone, and was actually down to 7%. So it wasn't quite to an extreme, but it's pretty low. And then the rally off of the low today brought them both up higher and sets up for another bullish near-term bounce after the holidays over. We'll see how long that lasts. We are going to be, once market opens back up, we're going to be 2 months into this intermediate run. And that's what we were expecting. Once you get to the end of intermediate rallies, you start to get more frequent near-term rallies. This one didn't last hardly at all, and we were done. We will start to get smaller. The typical range is 7 to 12 days of the blue line staying above 50. We've only gotten like 5 days the last couple of times, 5 or 6 days. So they're going to get smaller, but as long as we keep peaking above 80 and the lows are between 20 and 50, and we're getting higher highs and higher lows, when you look at the price itself that correspond to these peaks and valleys on the indicator, then we continue to trend higher. Now, the bounce that we get next week, the expected bounce we get next week, and of course anything can happen, right? But if it plays out according to this indicator and we get a bounce next week, it will not look like this. I almost can guarantee it won't be that strong of a bounce. That 4-day rally there was really strong Friday, and then the gap on Monday, and then all the way even through Wednesday's strong move higher. So if we do go up, you'll see I'll show you in other charts here in a minute why. But if we do continue to go up, then it will be slower and we'll just kind of grind up. Look how far up above the 30-day moving average we already are, the green moving average. So don't expect another move like we had this week, early this week, to occur again next week. In fact, I would I would venture to guess it's really, really low odds. But I do think that we'll move up to at least slightly higher highs than 29.16 next week, if not kind of coming back up to it and testing around that area as the near-term line bounces up too. Now, if it doesn't happen, if the near-term bounces up and say peaks at 60 and rolls over, similar to something like this here in June over here, and we don't get up to higher highs, then now we'll have the start of our intermediate pullback, and the Fibonacci lines are drawn to tell us where to expect the intermediate pullback to find support. So these Fibonacci retracement zone here in the middle, that's where it can pull back and find some support area. The 23% Fibonacci line, which is kind of that first area, happens to line up with this old high point from January. So the actual first layer of support is going to be there. It's not as strong. We didn't trade a lot in this area, so it won't be that strong of a support. The stronger support is going to be down in here. But there will be support there nonetheless. And you know, again, into this Fibonacci retracement zone, there's the old intermediate high points. That's why I've got this blue line drawn here, which is actually, now, if we continue higher next week to new highs, then we're actually going to bring this, you know, we'll have to move these lines, right, because it's attached to the high point. It will actually bring these Fibonacci retracement zone higher to the point where the old intermediate high point might end up being at the bottom of that retracement zone, which would be a very good sign for the markets if that were to happen. So again, you would expect some intermediate pullback. It's not gonna stay shaded green forever. You're gonna get an intermediate pullback at some point. The market's not gonna end. We're not gonna be in a bear market. It's just gonna be a pullback, and then you would expect a new intermediate term run to start, especially considering all the data I've been sharing in terms of how bullish you would expect the end of the year to be. First of all, because of how bullish January was, and second of all, because of how bullish August, you know, April through August has been with a 5-month winning streak. I've been sharing the data that Ryan Dietrich has been tweeting out, where the expectations going into the end of the year, and for September for that matter, are pretty bullish based on how bullish we've been these past 5 months. That culminates and ends today. Since the week is over, let's take a look at a weekly chart and you can see the near-term line for the week is right up into the upper reversal zone, good, strong, bullish trends. We did get a cluster, an overbought cluster last week, you know, but you know, nothing too. You can see you can get overbought clusters and still keep going. You might slow down a little bit, so you slowed down there and you slowed down here, but this trend still persisted. So you know that you know, back in July of last year, we'll take a look at that here in a second, and then again in October of that year. Remember, that was when we were supposed to kind of get a, you know, we had this 5-month intermediate rally. We had a intermediate run, a pullback here, but we were supposed to get an intermediate pullback here. We never did. We bounced almost right back up, and this ended up being a 5-month rally that we ended up, you know, all that fluff was taken out of the market in 2 weeks, in a matter of 2 weeks. So that kind of shows you the importance of having regular ups and downs. Considering we got this cluster here, you know, we could start to get an intermediate term pullback sometime in September, especially if this near-term bounce fails this week. Even if we do get the near-term bounce, again, expect it not to be like last week or this week, early this week. Expect it to be slow, slightly higher highs. Expect those near-term runs to get more frequent and shorter before we ultimately get the dark pink shading on the daily chart. Now, it is the end of August. We actually get to look at a monthly chart too. Here's the monthly chart, and you can see here. Let's get rid of some of these other drawings down here. They're kind of cluttering things up. You can see just how bullish we are. Those are the Fibonacci retracement levels, the full retracement down to July, the low point on July. But again, you can see the near-term line has just barely gotten up above into the upper reversal zone. The last time the near-term line dipped below 50 here, so this would have been in 2016 before the election. That was the last time the monthly near-term line dipped below 50. You know, it jumped back up in December. We actually got a cluster in December, but you see how the near-term line stayed up for quite a while. Then we get this dip that brought the near-term line down, and then we stay up. Even this dip here in early December, once the near-term line crossed back up above 80, it stayed up there for a few weeks before that pullback. And you can see other instances, back in 2012 we got a pullback and we stayed up above 50 and stayed up above 80 for quite a while with multiple monthly clusters. So needless to say, now that we're back up above 80 here, we could be on a multi-month, which again coincides with the expected bullishness you would expect into the end of this year based on January, based on this 5-month winning streak that we've had between April and August. All right, before we look at some other charts, a reminder that you can watch our Market Outlook videos here on MarketScholars.com. Just click blog at the top, find tonight's Market Outlook video, Market Outlook post, usually listed towards the top. Do you want us to do this video again Tuesday? Let us know. And the way you do that's with 3 simple clicks you can do right now. Click on that heart right there on tonight's Market Outlook tweet, and then click on like. That lets us know there on Twitter. You can click on this Facebook image. Takes you to your Facebook page where you can like tonight's Market Outlook Facebook post. It's posted to either my or Brandon's page. You'll see that coming up here. There we go. Just click on that like button right there, and then finally click this like button on the blog. Doing those 3 things lets those Twitter and Facebook and WordPress know here that this is good content that other people that they should share out with everybody who follows our accounts there. Of course, remember you can also scroll down to the bottom and comment on anything from tonight's video here on the blog. You can also comment and continue a discussion with other market scholars in our Market Outlook forum, specific forum there. Remember, you have to subscribe to participate there. Just click on this image to the top right. One more quick reminder too, no classes on Monday. It's Labor Day on Monday, so our next class for premium Market Scholar subscribers will be Tuesday with Brandon's Dividend Growth Investing class. All right, so back to the charts. One interesting development this week is another long upper shadow. Those tend to be bearish, those long upper shadows. You notice that that we have this long up. We had a long upper shadow a few weeks ago. We didn't close below that. We also had a hanging man pattern 2 weeks ago, and we didn't close below that one either. So that's why they never really converted. I mean, these one candlestick patterns need confirmation, which is the close back below. You notice we also had a long upper shadow there that we didn't confirm the next week either. So, again, it's a sign of weakness. So that's something to keep an eye on. That can ultimately turn in at some point in time, like I said, into that intermediate term pullback, or where we'll get some pink shading. But as of right now, I mean, we are well above the 50-day moving average. You can see the price here. This is the 50-day above the 200-day that continues to widen out. But if I were to change this to show you, if I were to change that there to show you the current level compared to the 50-day or a 10-week moving average, you can see just how high up above we are. I mean, look across, and it doesn't necessarily mean we have to drop, but it does mean that we'll slow down from this really strong pace that we've had really since the end of June, beginning of July, that we've had to get up this far above this rising. This 50-day moving average has been rising itself, so it's really had quite the pace to pull away from that rising 50-day moving average. And if I were to do the same thing and show you the current price relative, relative to the 200-day moving average, which is right here, you can see again just how high up above the 200-day moving average we are. We're pretty high up, and again, that doesn't necessarily mean we have to drop. But it does mean that we'll slow down a little bit, and you can see even back in here we continued higher, but it was at a much slower pace with a little bit more volatility. All right, when you look at the 3 green arrow chart, you can see we still have all 3. We're losing some positive momentum according to the MACD. The buyers are still in control. We're still above 75th percentile there. If you take a look at the 2-line versions of this, you can see despite this 2-day pullback, we are still above the 8-day moving average. And the reason why, again, I say that we won't get a move like we did last week, where Friday, well, at least this week, Friday and then early this week, we're not going to get that kind of a bounce coming off of this 2-day decline that we had during that 2-day decline, because the MACD was lower at that point than it is now. So There's more room for it to go up. Even the stochastics wasn't as, the percent D line of the stochastics right here wasn't as high as it is now. So we are more overbought now. We still can bounce, just expect it to be slower and more grinding, and those near-term runs to be quicker. They won't last that 7 to 12 days. Probably won't even get to the 7 days. Probably going to be more like what we saw here, 3, 4, maybe 5 days. But again, not to that extent, not that strong of a move here. It'll be more grinding. When you look at today's move, you can see, look at all the volume that came at the very end of the day, and not as much throughout most of the day here. And this was that key line in the sand, pretty much below these lows that we had, so right around this 289.5 area. Had we broken down below that 289, probably 289.25 and lower, then we would have filled in that gap down to last week's high point pretty easily. So that was a key level that we were looking at back here when just as we were doing that technical analysis class, like I said, for our premium Market Scholar subscribers. But we held. We retested it later in the afternoon, but held again and then bounced. In fact, we're even bouncing in the after hours. Here you can see we're up to 290.63, and we were up a little bit higher than that even earlier. We're almost right back up to today's high point in the after hours. Friday on a holiday, so it's not a whole lot of volume. I wouldn't put a lot of stock into it. But again, it just kind of shows how not bearish this little pullback has been. As dire as headlines may seem, right, when we get this kind of a pullback. Lower high, lower low, closing in the middle of today's range, closing in the middle of pretty much of yesterday's range. So not that bearish. Slight bearish bias because of the lower highs and the lower lows, but not more neutral than bearish. And you can see easily in the high upper end of the 4-week range. This purple line is last week's Hakinyashi candle. If we take a look at this week's next week's Hakinyashi candle open, which would be right here. So pull up the Hakinyashi candles, and you remember the open here. The open is going to be based off of this week's candle. So that the next week's open, so that's what this blue line, next week's open is going to be 287.29. That's where we're going to open on the Hakinyashi next week. So if you take a look at the intraday chart again here, and then now we change this purple line to, what do we say, 287.29. So it's a higher level, higher open than last week. So that's, as long as we're trading above that purple line, then we will not get a lower shadow on the candle. And you can see how far up above we already are at 290. So we're already, if that's the open, remember the close of the Hakinyashi is the average of the open, high, low, and close. So you already got that size of a body, depending upon where we open Monday. So you're still looking pretty good for next week, but it's gonna again, as we look at on a week-to-week basis here, those candles, as they start to get smaller, that's when you start to worry about the change of a trend. Similar to what we got a couple weeks ago. We get another candle like that this week, or a smaller body than what we saw this week, then you'll say, okay, we'll get that intermediate term pullback, which again will not be a bad thing, because that will give us what we need to make the end of year run that we expect. All right, so let's go back to, let's see here, this chart. Look at SPY, and you saw today's range really small, less, 1.5 points versus 2-point average. You can see the volume with a lot of that bullish volume. So look at there's a lot of that volume you can see came in at the end. So some pretty decent bullish volume today. So it's hard to be too bearish on that kind of a day when you've got below average trading range, 1.5 points, and that average still has room to fall, so still has room to be more bullish. The relative ATR is still easily in the bullish territory. You'd have to get, like I said, consistent daily averages of 3 points or higher on the ATR to get this average to start to move higher into the bearish zone. So we're not there, and you can see how low volume is. So all of these are in bullish zones. And volatility, if you look at the VIX, a lot's been said about the VIX moving down and moving up in this case. That just gives us room for it to go down again. Again, grinding lower, as we grind higher in the index itself. And you can see on a relative basis, as it did jump up here to 13 to 14 even, it's still, by the end of the day, closed right at the sweet spot for the bullish zone. So not that bearish of a volatility jump yet, but enough of a jump to allow it to pull back a little bit. So to summarize, we are bullish. We are very bullish. We've had a little bit of a pullback that should propel us up to a short-term bounce next week. Will not look like this week's short-term bounce. It will be smaller. It will be at a much flatter angle than this week's. If it does bounce, right? If it doesn't bounce, obviously anything can happen next week. But that's what I expect heading into after the Labor Day is over, and all of our favorite college teams are tied for the best record going into week 2. Right, we can say that for 1 week, right? Once you get to week 2, and by about week 4, now there's starting to be a little separation, right? But eternal optimism for everybody, at least in week 1. So that's what I think. I think we are kind of in the last legs of this current intermediate run, but it doesn't mean that we are now downhill from here. I still expect multiple intermediate rallies through the end of the year, if not into the beginning of the next year's first quarter, based on the charts and based on a lot of other factors, data I've shared with you from Twitter in the last few market outlooks, as well as multiple risk appetite ratios that are starting to turn back higher again, that have been pulling back during the past few months, that are rolling back up just in time for an expected end-of-year multi-month rally. So what do you think? Do you agree with that, or do you disagree with that? Let me know with that poll that's popping out in the top right corner of your screen. Click that link up there. It opens up the poll. Then either click on agree or disagree. Of course, if you disagree, which is perfectly fine, scroll down to the bottom and let me know. Let me know what you're seeing that would suggest otherwise from what we've talked about here in our Market Outlook video tonight. All right, now let's transition into what's driving price action today. It wasn't a whole lot on the calendar. You had Chicago PMI coming in a little bit below what was prior and a little bit below the estimates. Still relatively high levels when you look at it here on the chart itself. That was the biggest release. Consumer sentiment was revised slightly higher. Still pulling back a little bit, still relatively high levels. So, pretty good bullish economic indicators, but not overwhelming the estimates. And that's why it's bringing this down. And that's going to put pressure on yields. You'll see yields unable to gain some real good traction as long as this economic surprise index still points lower. Once it bounces, different story. But as of right now, and even you can see the rate hike odds. I mean, they're still pretty high for December to get that next rate hike in December. But then once you look past December into January, you can see very, very low odds for a rate hike in January, 3%. In March, it does jump up to 9%. So still, it's higher than it was yesterday. It's higher than it was a week ago. Not higher than it was a month ago. So from a month ago, we're actually down a little bit when you combine those two numbers together. So the odds of a rate hike, are slowing down, and again, the function of economic indicators not necessarily dropping. I mean, you can still see GDP estimates are still relatively high, and Q2 is high. So it's not like these economic indicators are worsening. They're just not growing, as we saw on the calendar. They're still relatively high. It's just hard to get too much higher because of how high they already are. And so you're starting to see some slowdown there in these rate hike expectations and economic growth estimates. And like I said, that usually will put some pressure on like the 10-year yield. Not necessarily push it lower, but keep it from making its move higher. If you take a look, you can see TLT was actually up today. It ended up down. It was one of the better, earlier this morning, it was one of the best performers before pulling back. Here you can see the move it made on an intraday basis. So a little bit of an engulfing pattern there. All these other bonds, high yield bonds bouncing up. You can see preferred stocks are rising. Yields rising. Preferred stocks went up with the dividend stocks, though not necessarily bouncing. And real estate stocks kind of holding near their 3-week highs. There's your real estate stocks. Broad rally today. I mean, S&P was only up a smidge, but IWM was up strongly. Mid caps were up strongly. Corporate bonds outpacing. Where's your investment grade? Right there, outpacing investment grade. That's a bullish relationship. You did have ag commodities bouncing up. Remember how oversold they are, so that's one of the main reasons why they're bouncing up, even with a strong dollar. And you can see the strong dollar having an impact more so on developed markets than on emerging markets. So something, I do think had we had another day of emerging market bloodbath today, then we'd have been a lot more concerned. But the fact is, Europe was our biggest losers. Here's Spain. Let's see, here. Let's go to the combined markets. Here's France, Italy, Germany, Canada. Of course, you know why that they're struggling, especially at the end of the day, with the trade deal not going through with Canada. Spain, UK, Australia pulling back with Canada. You can see Netherlands there, Sweden, Switzerland. So those are all your developed markets, all underpacing ACWI. On the other end of the spectrum, Argentina bouncing up after Thursday's bloodbath, Brazil bouncing up with it, Russia, one of your underperformers in the foreign market space. Here's Russia down here in the bottom. It's bouncing up off of some lows. Of course, Turkey has been struggling. It's bouncing up. Taiwan and Korea doing well, and there's India bouncing off of after some recent weakness. So again, had it been another day of emerging market weakness, then we could start worrying about contagion, right? Spreading into the U.S. and finally pulling this down along with them. But that wasn't the case today. It was more developed. You can see here's Germany pulling back below its moving average and bearish again. There's Italy closer to its 3-month lows below a falling moving average. France falling back below its moving average on a sideways move. Canada really dropping sharply. UK bouncing off of its falling moving average and rolling back over. So you can see how it's shifting. And having emerging markets outpacing developed markets, as long as U.S. stocks stay up, is actually a pretty good sign of risk appetite. From a sector standpoint, discretionary in technology were two of your best performers. They continue to be two of your better performers. You'll start to see, your safe haven areas, which had been doing well, starting to pull back. Real estate, like I said with VNQ, these REITs are holding their ground near 3-month highs. Those are really the only areas. Industrials are bouncing up a little bit too and outperforming the S&P. On the other end of the spectrum, energy stocks declining with that strength in the dollar. Materials also pulling back too, and of course utilities pulling back with the jump in interest rates. A small jump in interest rates, not helping financials very much. But you can see where your weakness are, your pink charts, and they're all above 50, so they're not that bearish. But those are where your weakness are. And you can see the ones that are above 90, technology, healthcare, discretionary, telecom, all above 90. Industrials close to being above 90. Financials pulling back a little bit, falling, but still above 80. You can see real estate holding up too and above 80, and materials falling, but still above 80. So a little bit of weakness here in some of these areas, but our strength remains in the areas where we've had strength. That won't always be the case. In fact, I would venture to guess by the time we finish this market sentiment run, technology and discretionary and healthcare will not be the leaders. You'll probably start to see energy and materials work their way towards the top, if not these safe havens work their way towards the top. So I would venture to guess those are going to, they're already there, but they'll work their way back. They're going to start falling here. They're going to work their way back toward the top. Again, this is all based off of Brandon's sector selector rankings that will be coming out over the weekend. So make sure you check our blog for the new rankings heading into next week. But you'll probably start to see those start to falter, and you'll see technology making a run back and industrials making a run back towards the top is what I would guess. with healthcare and discretionary maintaining their position to the top of the list. You might start to see some rotation eventually into these industrials and energy and materials areas by the time we finish. And again, end of the year, first quarter of next year, most likely. All right, well, one stock that we have in that utilities area that's starting to show some weakness is, you can see here, NextEra Energy. It's been pulling back, nothing more than just a kind of a bullish pullback, but you can see a little different in that we're coming down from a divergent high point on the MACD, so a much lower high compared to a higher high. That sets a target for that divergence to be the low point in between, which is down here to this 165 area. The MACD is now dropping below zero, and so unless we get a strong bounce next week, which would not be expected, like we had here, there's and the stochastics is already into the lower reversal zone, unlike it back in the end of July, beginning of August. So a little bit more bearish of a low point than we had back here, threatening the 30-day moving average. You can also see on the Bollinger Band basis, getting into the lower half. You can see the Bollinger Band had been trading in the upper half with only a brief foray, little bit more time now in the lower half of the Bollinger Bands, with the Bollinger Band width turning up. And also you look at the DMI for NextEra, and you can see its positive line had been above 25 or been above 20. Neither one of them is above 20 right now. So there is setting up the potential for a breakout, and the stochastics and the MACD would suggest that a breakout of one of these two lines would most likely be, and the divergence, that a breakout could be to the downside. And again, most likely just down to this 165, 167 area, which for us is all we would need to do a bearish trade if we were to, again, I'm not necessarily bearish to the point where I want to buy a put on this, but bearish enough to say, you know what, we've got a high point at 175. Unlikely that we'll break through to new highs in the utility sector anytime soon. So let's sell that 175 call and buy the 180 for protection, and that will give us an opportunity to have a little bit of bearishness in an active trading portfolio ahead of maybe some potential intermediate pullbacks, but also bearishness in a weak sector, a sector that we would expect to weaken as the market heads into the end of the year, into a bullish seasonal period into the end of the year. So a little bit of a wide spread. We have to play with the spread in between to see what we can get. Ideally, like to get $1.16. Considering it's a utility company, you might not be able to get that much, and you've got pretty decent odds. So if it does bounce up a little bit, let's say up towards today's high. In fact, if you look at today's intraday move, the stock actually started pretty well. It started up and got all the way up to 171.80 towards the middle of the chart of the 4-week range before dropping, and you can see why it's so bearish and why it kind of stood out to me was we did get below these lows from earlier this week. A little bit of pullback later, and we can still get a little bit more of a pullback and still be more bearish by staying in this range, but easily in the lower half of the 4-week range, and that 4-week range isn't, these lines are going to pull down anytime soon as that high point's kind of stuck there. So opportunity to continue to push the 4-week low point lower, a lot closer to the 4-week low point than we are the high point, which happens to be below the break-even of that spread that we just put on. The break-even point coming here, you can see the odds. That's why we're not getting quite the $1.16, the 30% return on risk. You got pretty decent odds heading into October. You also got a pretty easy divergent high point up there too, that will act as a resistance on the way up. And like I said, we're not even close to it right now, considering we're a lot closer to the 4-week low point. All right, that wraps us up for tonight. Now I want to hear from you. What do you think about the market posture tonight? What do you think about the trade idea? I want to hear your thoughts, your comments, any questions you have for me. Remember, you can do that with that link that popped out in the top right corner of your screen. Just go to our Market Scholars forums, and we can keep the conversation there, not just with me, but with other market scholars that have been that watch these videos day in and day out, just like you. So again, thank you very much for tuning in. Have a great Labor Day weekend. I hope you all get plenty of rest, and as we head into the fall and football season, and may all of your favorite football teams win their first game and keep the hope alive. So remember to subscribe on YouTube. click the thumbs up icon and comment. Also remember to follow me on Twitter for more content like this, and join our Market Outlook community on Facebook. Have a great one, everybody, and we'll see you all on Tuesday.